Welcome back to Wealth Architecture. I hope you're all well. Today's subject, redundancy. Let me tell you a bit about James, who had been working in finance for 22 years, senior role, good salary. One Tuesday morning, he was called into a meeting he hadn't been expecting, and by lunchtime, he was holding a letter and a number, £150,000, with no real idea what he was actually going to keep. That number, £150,000, wasn't what it looked like, because sitting inside it were several completely different things, each taxed in a completely different way. And one of those things, if James had known about it before he signed anything, could have meant £40,000 going straight into his pension completely tax-free, instead of losing roughly £18,000 of it to the Treasury. I'll come back to James. First, a number that tells you everything about how this country has treated people in his situation. The tax-free redundancy allowance hasn't increased since 1988. Not once. Not for inflation, not for anything else. Nearly 40 years frozen at £30,000. If it had simply kept pace with inflation, it would be worth somewhere close to £100,000 today. The consequence? For a senior employee with a generous package, that frozen ceiling gets used up almost immediately, and then the real tax bill begins. If you've just been told you're being made redundant, or you suspect it's coming, this video is about what's actually taxable in your package, what isn't, and the handful of things worth raising before everything's finalized. Some of that window closes the moment your final pay is processed. I'm Mark, and let's work through it together. Let's start with the good news, because there is some. Genuine redundancy payments, your statutory redundancy pay plus any additional contractual or discretionary redundancy payment on top, are tax-free and free of national insurance, up to £30,000. That's not £30,000 of your final salary taxed differently. It's £30,000 that simply doesn't get taxed at all, regardless of what rate you'd normally pay. What that means in pounds, if you're an additional rate taxpayer, £30,000 of normal income would have roughly £13,500 taken in tax. Here, it's all yours, every penny. Statutory redundancy pay is calculated from your age, length of service, and weekly pay, up to a cap. For most people, on its own, it sits well within this exemption. It's when a generous contractual or discretionary top-up is added on top that the £30,000 ceiling starts to matter. And that frozen figure from 1988? For a long-serving senior employee, someone like James, that £30,000 ceiling gets used up very quickly. Everything above it is taxed as income, on top of whatever else has been earned that tax year. But here's what really catches people. It's not the amount above £30,000 that surprises them. It's what comes off the top before they even get there.
James looked at his letter.
£150,000. He assumed most of it would be sheltered, or at least partially sheltered, by the £30,000 exemption. His assumption was wrong, and the mistake cost him money he didn't need to lose. Payment in lieu of notice, PILON, is money you receive instead of working your notice period. Since April 2018, PILON is always treated as normal earnings. Always taxed, always subject to national insurance, exactly as if you'd worked those weeks or months and been paid your normal salary. It doesn't matter whether your contract specifically allows for it or not. The rules change to make this automatic. Here's what that means for James. 3 months PILON at his salary, £37,500. Not a penny of it sat inside the £30,000 exemption. It came off the top first, taxed in full as earnings. The £30,000 exemption only applied to what was left, the genuinely redundancy-related portion. James assumed the opposite. The hidden enemy here is sequencing. The order in which a package is taxed isn't something you choose.
PILON and garden leave come first, taxed as earnings. The exemption only applies to what's left. Knowing this before you sign changes everything. Garden leave works differently again, but lands in a similar place. If you're put on garden leave rather than given PILON, you're still technically employed. You just don't have to come into work. Your normal salary continues with normal tax and national insurance for as long as the garden leave lasts. None of that is redundancy pay. It's just salary. So a package that sounds like one clean number is actually several different things stacked together, each taxed completely differently. And the order in which they're taxed isn't something you get to choose.
Here's where it gets genuinely useful, because there's a planning opportunity inside redundancy that most people, in the emotional weight of the moment, never raise. James didn't raise it, Helen did. Take Helen, 52, 20 years service, same package as James, £150,000, including £37,500 of PILON. Same employer, different outcome. The difference came down to a single question she asked before she signed. If part of a termination package is paid as an employer pension contribution rather than cash, it's treated completely differently. An employer contribution into your pension as part of a termination settlement isn't subject to income tax and isn't subject to national insurance, either yours or the employer's. And it sits outside the £30,000 exemption entirely. It's separate, subject only to your pension annual allowance. What that means in practice: money that would otherwise be taxed at 40 or 45% goes straight into your pension, in full, growing tax-free. Helen's package, taken entirely as cash, the £37,500 of PILON taxed as earnings, likely 45% on most of it. Of the remaining £112,500, the first £30,000 tax-free, the other £82,500 taxed as income, on top of everything she'd already earned, a large chunk through the 60% personal allowance taper, the rest at 45%. Total, after tax, somewhere around £90,000. Nothing in her pension. Now, the alternative Helen actually chose. Before signing anything, she asked one question. Could £40,000 of the package be restructured as an employer pension contribution? The employer agreed. That £40,000 went straight into her pension. No tax, no national insurance, in full. The remaining £110,000 was taxed under the same rules. PILON first, £30,000 tax-free, then the balance. The headline package was still £150,000 either way, but Helen kept a broadly similar amount in cash and had £40,000 extra sitting in her pension, completely tax-free. Money that in James's version would have lost roughly £18,000 to tax before it ever reached him. One question, asked early enough. That was the difference. Redundancy is one of the only moments in someone's working life where the structure of a payment is genuinely still negotiable. Salary isn't negotiable month to month. Bonuses are usually paid however the company pays bonuses. But a termination package, before it's signed, is, for a short window, a conversation. And the difference between cash and pension contribution in that conversation can be worth tens of thousands of pounds. The difficulty is that this is exactly the moment people are least equipped to have that conversation. There's often shock, sometimes anger, frequently a desire to just get it over with and move on, which is completely human, and exactly why it's worth knowing in advance that the conversation is even possible. James signed without asking. Helen asked before she signed. Same employer, same package, same week. The only difference was one question and £18,000. If you're facing redundancy or think you might be, here's what's worth doing. 1. Before agreeing to anything, separate out the different elements of the package in your head. PILON and garden leave pay are taxed as earnings, in full, regardless of the headline number. Only the genuinely redundancy-related portion gets near the £30,000 exemption. 2. Ask, calmly and early, whether part of the package can be restructured as an employer pension contribution. This is a normal question. It costs the employer nothing extra, and for you, it can be worth tens of thousands of pounds in tax that simply never gets paid. 3. If a large taxable amount is landing in this tax year regardless, and it's pushing you into the higher bands, consider whether a personal pension contribution from your own savings in this same tax year could bring some of that back down. The same mechanics from earlier videos in this series apply here too, just triggered by a different kind of moment. That's 5 videos now looking at the financial decisions that show up at specific moments in life. Divorce, inheritance, property, a bonus, redundancy. Different mechanics every time, but the same underlying lesson running through all of them. The system doesn't tell you when these moments matter most. It just responds to what you do or don't do within them. And in every single one of these videos, the people who came out ahead weren't the ones who knew more. They were the ones who asked one question at the right time, before it was too late to matter. I hope you found our chat useful today. I'd really appreciate you subscribing. If you've got a question, or there's something you'd like me to cover in a future video, leave a comment below. I'll do my best to help. Until next time, take care.